Hi, my name is Brock Vandenberg and I'm the president of Talamar Financial. We are a private lender here in San Diego and we manage Talamar Income Fund 1, a mortgage fund that is structured as a real estate investment trust. We've got a great topic today. We're going to talk about some of the advantages of why a mortgage fund should be structured as a real estate investment trust. We're going to talk about why the 2017 Jobs Act was so important for mortgage funds and the income that they generated. And then at the end of the day, how you are taxed on that income. So let's go ahead and get started. One of the biggest reasons investors consider an investment in a mortgage fund, which is structured as a real estate investment trust, is because of the 20% qualified business income tax deduction, also known as Section 199A. In general, the QBI tax deduction allows owners and investors in small businesses to deduct up to 20% of the income that passes through the business to the individual or investor. In other words, only 80% of the income generated from the business is taxable at the individual level. Today, we're going to explore why the tax deduction was created and who qualifies. We'll also explain why the REIT component of a mortgage fund is so important and allows its investors to circumvent both the income type and income cap that would normally restrict investors from receiving these favorable tax benefits. Why was the QBI tax deduction created? The QBI tax deduction was introduced into law through the 2017 Tax Cuts and Jobs Act. The idea was to make corporate tax rates in the United States more competitive internationally and to introduce tax incentives for corporations to repatriate large sums of money they had earned overseas and to invest those funds domestically in hopes of creating higher paying jobs. The result was that corporate tax rates were reduced from 35 to 21%. The reduction, however, didn't help small businesses who were structured as a sole proprietorship, LLC, S corporation, or other entity that are classified as pass-through entities. The term pass-through simply refers to the income being earned at the business level but being passed to the owner or the investor and being taxed at the individual level. Historically, the tax rate that an individual from their business income would expect to pay would be significantly less than the tax rate U.S. corporations would pay. Think Walmart, Amazon, Apple, and other large corporations. As a result, language was added to the legislation that allowed small business owners to take a 20% tax deduction on the income that was generated from their business. The 20% tax deduction was called the Qualified Business Income Tax Deduction, or QBI tax deduction. The tax provision gets much more complex as there is language regarding the type of income that qualifies for the tax deduction, how the deduction is calculated, and income limits on individuals that are eligible to receive the deduction. We're not going to get into the details on those restrictions. However, I would recommend you taking a look at the information posted by the IRS on their website, and I'll go ahead and put a link in the description of this video. Mortgage funds make the majority of their income from the interest that borrowers pay on the loans in the fund. If the mortgage fund is privately held, the mortgage fund would generally be structured as a general partnership, LLC, or S corporation, and therefore the income would be passed through to the investor in the form of a dividend. The investor would pay tax on the income at their individual tax rate. But there is an issue. If the mortgage fund is simply structured as a pass-through entity without the real estate investment trust, the investors most likely are not eligible to receive the 20% qualified business income tax deduction. The IRS included specific language in the provision that restricted income generated from capital gains, dividends, interest income, income earned outside of the United States, and certain wage guaranteed payments made to partners and shareholders. Being that the income generated from the mortgage fund is considered a dividend, the investor would be excluded from the tax benefit. The IRS outlines that income generated from a REIT is excluded from this provision and is eligible to receive the favorable tax treatment. In other words, if you are invested in a REIT mortgage fund, you are eligible to receive the 20% tax deduction. But it doesn't end there. The same provision that excludes certain forms of income that is eligible for the QBI tax deduction also places an income cap on individuals that can claim the deduction. In 2023, the income limit was set to $182,100 for single filers and $364,200 for joint filers. Therefore, individuals or couples whose income exceeded those amounts weren't qualified to earn the tax deduction. But again, the REIT provision eliminates this restriction and makes all investors in a mortgage fund real estate investment trust eligible for the 20% tax deduction. Investing in a mortgage fund can be an excellent option for investors seeking to take advantage of the 20% qualified business income tax deduction on the income they earn. Because most private mortgage funds are structured as a partnership, LLC, or S corporation, the income they generate is passed through to the investor and taxed at the individual level. Though the 2017 Tax and Jobs Act provided significant tax advantages for pass-through income, the income generated from a general mortgage fund was often excluded because either it was in the form of a dividend or the investor exceeded the income cap. However, the same legislation included a loophole provision that allowed income from a real estate investment trust to be eligible for the favorable tax treatment, no matter how the income was generated or the income of the recipient. So if you're interested in investing in a mortgage fund, I highly suggest that you consider mortgage funds that are structured as a real estate investment trust. If you're interested in learning more about investing with Talamar Financial or our mortgage fund that is structured as a real estate investment trust, please give our team a call. If you like this video, give us a like and definitely subscribe to our channel. We post a ton of great content about investing in mortgage funds, investing in trust deeds, and just general investing in the real estate market. Thanks for listening.